Hey, good morning. I'm going to walk you through the latest data from Experian. Every quarter, they put out a automotive finance market update, and honestly, when you look at this data compared to last quarter's data, plus some of the headlines from banks like Ally Financial, you can start to see why folks are getting concerned about what's going on in the auto industry. All right, let me share my screen and let's jump right into it. So first things first, Q3, Q2. We're going to look at Experian data from Q2 and from Q3 and do some comparisons. And first, I want to kick things off with this article from Ally Financial about 6 weeks ago. Okay, Ally Financial cuts view as it prepares for more auto loans that won't be repaid. There's this concept of loan loss provisions that all financial institutions they have to set aside money for loans that they don't think are going to actually come to fruition, that people are going to stop paying for. And what's important to read here is this. In another troubling sign, the company said it expects 1.6% intermediate term net auto loan charge-offs, a figure that represents money the company does not expect to collect. The 1.6% figure is at the high end of their 1.4 to 1.6 projection for net charge-offs on auto loans. 1.6, that is the important number to remember here from Ally Financial, one of the largest auto loan lenders in the world. I want to start with Q2. So this was data that was published in August of 2022, and I'll link to this data down below in the description. I am going to jump, there's a lot of slides here. I'm going to jump to slide 44, and this is where I want you to follow along if you pull up the data as well. Again, this is from Q2 of 2022. At the top of the page, you're going to have the percentage of loans that have gone delinquent. At the bottom of the page is the percentage of balances that have gone delinquent, okay? We're going to focus on balances because that's what Ally was saying as well. They were saying 1.4 to 1.6% of their balances were going to go delinquent, and they were going to charge them off. Those were going to be vehicles they were going to repossess. People were going to stop paying on their loans. This is from Q2 of 2022, and Experian says 2.29% of auto loan balances were delinquent by 30 days, and 0.73 were delinquent by 60 days, right above my head there. If you look at the trend, we had obviously a significant decline. I'm looking over here at Q2 2018, Q2 2019, 2.79%, 2.66%, and a significant decline when the pandemic started. A lot of stimulus money and things like that. Auto loan delinquencies plummeted. I mean, no one really was concerned about paying for their auto loan. They had a lot of free cash on their hands. As we've come out of the pandemic, we've seen it increase. And again, in Q2, it was 2.29%. So let's look at Q3 data. So I'm going to pull up the Q3 report, and again, this will be linked down below, and it's all the same stuff, just updated for a new quarter. We are now at 2.54% of auto loans that are 30 days, of auto loan balances that are 30 days or more delinquent. If we jump back to Q2, that was 2.29%. That is a significant increase, 20 plus basis point increase to 2.54%. And of course, when we look historically as well, it's up, encroaching upon where we used to be pre-pandemic. If we look at the 60-day delinquencies, we are up to 0.9% of auto loans, which is on par with where we were pre-pandemic in Q3 of 2018 and Q3 of 2019, and up significantly from prior years. And again, let's jump back to just last quarter. It was 0.73. That's a 17 basis point increase in just one quarter. That is huge. That is significant. So again, if we focus here, let's just focus on 2.54% of auto loan balances are delinquent. That is what Experian is telling us. And then we go to one of the banks. Okay, and the bank has to share a positive message with their stockholders, their shareholders, to try and keep their stock price high. Ally's out here saying, no, only 1.6% are going to be charged. No, it's going to be more. It's going to be 2.6%. I mean, every expectation we have, this is the Q2 data here, again, 2.29, 2.54. Every indication we see is that loan delinquencies are going to continue to go up and surpass pre-pandemic rates. This will go up past 3% in another quarter or two. And Ally Financial and other financial institutions out here, yes, they are increasing their loan loss provision, but I don't think nearly enough to offset the fact that a lot of folks are going to simply walk away from their auto loans because, and that ties in with the next point here, because car prices continue to go down. We have data from the CFPB that is showing consumers that have deep subprime and subprime credit, their loan delinquency rates are skyrocketing significantly faster than any prior year. And there's an interesting point here. Yeah, here it is, right here. An escape hatch. Blah, 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 blah. Some consumers can extinguish a large part of their loan by selling their vehicle because lenders earn more money from that outcome than if they repossessed the vehicle and sold it at auction. However, if used car prices continue to drop, which they have been, this solution could close and put consumers falling behind on their payments in an even worse position. These subprime and deep subprime borrowers who had poor credit scores to begin with could end up with repossessions on their report. This outcome, Kukla said, also negatively affects lenders. The reason the current escape hatch works is because lenders are able to get their money back and borrowers are able to extinguish their loan. If a lender has to repossess a vehicle that has decreased in value, it impacts the way we do business. Quote, if you got a loan that's supposedly to be secured by a $40,000 car that's now secured by a $20,000 car, you have a little less leverage. What does this mean for the lender, for what the lender does after the repossession? The reason I bring this up is because car prices, used car prices, they went up last year. And we have a great article on our website, joinyaa.com, that talks about what we expect used car prices to do in 2023. Used car prices are down 17% at the wholesale level just in 2022. That's after going up 50% last year, but that puts significant amount of pressure. Yeah, you can see here, car prices went up more than 50% thanks to all that inflation. That puts a significant amount of pressure on any consumer who's paying off that auto loan. But it's almost like the housing crisis back in 07, 08. Like the value of that vehicle, the value of that loan, it doesn't correlate. And we're seeing more and more people walk away from that. And that's one of the biggest concerns for the banks, because ultimately they're the ones that are holding on to that liability. They lent the money against a $40,000 asset that's secured by that $40,000 asset that's now take 17% off of it or even more. And so you're seeing here a really logical case for why financial institutions are tightening their lending guidelines, which is also paired with the Federal Reserve increasing the federal funds rate, which is increasing interest rates. This is why you're seeing a significant slowdown in consumer demand in the auto industry. That's also being paired with a significant increase in supply thanks to repossessions, because a lot of folks are walking away from their auto loans. You pair those two things together and you get a really clear picture as to why we expect to see car prices decline even more in 2023. And I wouldn't be surprised that, come February, March, when we get the latest data from Experian, the CFPB, TransUnion, etc., you're going to simply see pre-pandemic levels of delinquency rates. We're going to match them and then surpass them, and ultimately that will drive more inventory in the markets, further lowering prices. Not a pretty situation. The banks are starting to get worried, and I imagine as you see Q4 earnings reports from the Ally Financials of the world, the CarMax Financials, financing companies, you're going to see some alarm bells start to be rung, and you know what? You'll have heard it here first. All right, let me know what you think of this information in the comments down below. As always, thank you for watching.